Hey everybody, Preston Brent here with our Trader User Group. This is our first weekly roundup for 2016. This is for the first full trading week in January, ending January 8th, 2016. We had a nice holiday break, and now we kick off a brand new year. Last year was nice for us. A lot of people that were following some of the trades we were taking did fairly nicely. If you are new to this free broadcast or interested in what we do, then I highly encourage you to come over to our website and check us out. I think 2016 is going to be even a better year than 2015 from a profit potential. There are a lot of things starting to shape up here for us. So without getting too far ahead, what I want to do is let's start right now with the S&P 500 futures, the E-mini futures. What you see on the screen right here are the E-mini futures, and I've got a daily chart, but I've got it set up so that you can see some Fibonacci's in here, and you can see I've put it off the lows here of about 665 that we made on March 9th 2009, and then the highs up here at 2134 in May of 2015. And then I plotted some Fibonacci's. Now, it's really important when you start a new year to do a couple of things with your charts. You need to take a step back, because you've been living in the forest you've been living, in the bushes for a while, following the day-to-day machinations of the market. But it's good to kind of take a step back and just look at where we are. As you've seen, we've been on this terribly strong bullish move up like this. So it's been really good. But as we've started 2016, I think I'm seeing, and just looking at the stats, it's the worst start we've ever had on record. But that really doesn't mean anything. The start actually didn't start in 2016. It started about the middle of the middle of December of last year, possibly even sooner than that, and it's just carried over into 2016. So not like we're coming off of highs of 2015 and now we just all of a sudden start going down. We've been going down before that. We've been going down. We made highs in May of 2014, and as I said, we're working down. But needless to say, 2016 is not starting very strong. We're down year to date, which is only about a week, but we're down in this contract here in the E-minis. We're down 6.1%. The worst performer year to date so far is the Russell. We're down 7.8%. And I'll point out that off of the highs made in the Russell, we're down 19.2%. Now, if we fall 10% or greater, it's officially called a correction. I mean, I don't come up with these rules, but that's just kind of what most analysts agree on. So any kind of 10% pullback from the highs, it's a correction. A 20% pullback from the highs is you're now in official bear market territory. So guys and women, we are right now 19.2% off the highs for the Russell, small cap and mid cap. If we look at the E-minis, we're down 6.1% this year, but we're now in official correction territory, which we entered on Friday at 10.3%. So we off the highs of 2134, as you can see on the chart in this past summer of 2015, we're down 10.3%. The Nasdaq, we're down 10%. Now the Nasdaq was one of the strongest performers in 2015, but it's given it all up. We've fallen very quickly on the Nasdaq. But the Nasdaq year to date is down 10%. So we are, you could call that an official correction for the Nasdaq. And then if we look at the Dow, we're down 6.4% for the year, and we're down 11.4% off the highs of the Dow last year. So we're in official stock market correction territory. But the reason why we step out like this is I did want to show you that we're still in a secular bull market, meaning longer term. We are in this bull market. Now let me just see if I can't draw these lines a little bit better here. Well, let's just get about like that. So if we put this on here like this, in fact, let me just take that off and let's use a trend line here. If I just select my trend line tool and come on here, and I just want to show you kind of where we're sitting here, and then if I duplicate it, like this and just add it on the top. So we just kind of make our own channel, I guess. You can see right here where we got a little bit ahead of ourselves starting in the summer of 2014, and then we finally fell back into this channel again in August of 2015 when we had that big August pullback, which I'm going to show you here in just 1 minute and kind of compare that to where we are now. So you can see on this upward sloping secular channel, going back to 2009, we're in the middle, okay? So I do believe we're going to come down and probably test this down in this area here. We may even come down to this area right here, about 1787. In fact, what I'm calling for is about a 1787 to 1795 area that would put us just south of the 1800 level. That would not surprise me. In fact, what I'm doing is I'm positioning my portfolio, so that's where I'm expecting us to go. I don't expect us at this moment to break this upslope and trend line. Why? Well, even though there are a lot of contagion effects going on from China and the commodity, which is driving the commodities into the basement, from oil, lower energy, and we'll talk about oil in a minute, and from we're no longer now lined up for free punch at the punch bowl by the Feds. Remember, they stopped doing stimulus last year, and then they started raising, or they were talking about raising rates, but they really didn't get to it until Q4 of last year. And they've come out just this past week and said they could see a gradual raise of 25 basis points every quarter through the end of this year. I don't think they're going to do it. I think right now the markets, the 30-day Fed funds futures rate is pricing in 2 rate hikes in 2016. Which would put us at 75 basis points, or 0.75%. That's what the markets are forecasting now. It was forecasting 1, but they've now taken it down to 75 basis points for the year. So that would get us down to this area here. We are expanding. Now, the big issue that we have globally is manufacturing. And I get that manufacturing is only 10 to 12% of the US GDP. It's a little bit more in Europe, but it's not high enough to really take a big bite out of it. However, in China, it is. And China is kind of an early warning signal. And we're going to go look at the Dow Transports also in a minute. They've officially entered bear market territory. And you would think with oil being down in the basement as well, the cost of oil and everything else, transports would be benefiting, and they're not. Why? Because manufacturing, they're not shipping. And if they're not shipping, people aren't ordering. And I don't mean just consumers. I'm talking about all the way down the supply chain to the manufacturers and the producers and the OEMs and everybody else that puts things together that we eventually buy at all the retail outlets. So the big question for 2016, is that going to cause a ripple effect and be enough to pull the consumer spending in the U.S., which, by the way, is increasing, which counts for 70% of the GDP up, or will it be a hindrance on GDP and push us down into an official recession? And remember, a recession, generally, you don't know you're in it until you're out of it. Some people argue that we're still in a recession. I'm not in that camp. So right now, I believe we're going to come down and we're going to hit this area down here like this. And then we're going to have to watch the data very closely. But if China continues to monkey around with their yuan, every time they devalue it, it's a ripple effect globally. And I believe China, although they came out and said their GDP is probably going to come in at 6.8% for 2015, I believe next year they'll be lucky if they get over 5.8%. Now, what does that mean? Now they are converting over from an export-driven economy to a consumer-driven model, much like Europe, much like the US. That's where they want to go. There's going to be a lot of pain with that because they used to be doing 15% a year a decade or so ago, and now they've just slowly worked their way down the spectrum more to not a third world, but an industrialized country where it's driven more by the consumer model, which is what's happening over a 2-decade period. Now, how they manage this migration from the high to the low as far as their GDP goes is going to cause fits and starts in all the global indexes, and we want to take advantage of them here in our trader user group. That's why I think 2016 is going to be a fun year for us. If you are not a member, I highly encourage you after this video to go in and take a look. So enough of the sales pitch. Let me go in and let's take a look at where we're sitting here. So you can see as we step back, this is where we're sitting right now. And we've had a, from these little, we failed, we had this, we just could not get up here, and a couple of failed tops, and then boom, away we go. And we're now in this channel like this. And I think we're going to stay in this channel. We're probably going to have a false move up like that to sucker people in. And that little move there is probably anywhere from 75 to 100 S&P points. So while it looks small on this chart, because I've got it condensed down a little bit, it would take us to the top of this channel, and then away we go, and then we have another bounce, and then boom, we're down at this decision point here at a key fib node of around 1787, 1790 area, just south of the 1800. And when markets are trying to see a support level at 1800, 1900, 2000, it typically blows below it and then goes back up. Same thing on the top. It'll typically run over it and then pull back again. So we're going to have a key inflection point coming up here, I think, sometime in the month of January. It's not going to take us long to get there. Now, let's compare this move over the past couple of days to this huge down move we had last August. And let me just zoom in a little bit on this chart here. So I'm going to leave this trend line in here, this channel, just so that you can see it. And let me just get my screen set up here. So let's move in a little bit. And I'm going to adjust it so you can see it just a little bit better on your screen here. All right, so here we go right here. And then what I'm going to do is I'm going to go out to a weekly chart here real quick, and I want to show you guys something, and it's really interesting. And let me just blow it up again. So we're looking at a weekly chart right here, and you can see on this weekly chart we had this huge down move right here 1 week, and then the very next week, boom, we came down there, but not without a little bit. We opened lower and we went up a little bit higher. That was a head fake. Remember, this is a weekly chart, so it took a day or two to move up. So if you were to plot it out, it looks like that, and then we kind of went up like that, and then bam, we gave it up real quick, and then we formed the low. And then we came back up, we tested it, we came down, we did a double test, and then boom, away we went. That's where we got long, right in that area there. Now, is that pattern going to repeat itself here? And if we look, we see we've got a big bar down like that. So let's compare these two and just kind of see how they really stack up. So if I come in here, let me just come in here and let me go to my move here. If we look at that, that was the move down right there on that first week bar right there. So that move, let me just get it out here. So that first week down over here, let me get it lined up here. So that first week down, we moved 141 bars, okay? And then what we had a little bit of a dead cat bounce, and then we gave it all up. So if we look and do it again and see where we are right here, and we look at this bar right here, and then we just track it down here like that. Let's just go down like that, and then let me turn it off and move it over here like that. You can see right here that we moved down about 133 bars. So that move there in that 1 week was about 7.82%. This move here was about a little over 7.3%. So very similar. And that would suggest that we're going to get a little bit of a bounce next week, possibly, and then a quick rollover on a weekly bar. This next weekly bar, if I were to, just kind of plot the distance on this one, it looked like that. So we'll move it over here on the side so you can see. That was the next down move right there. That bar essentially moved down 170 points. So it actually moved even further down, as you can see. So if I were to take that ratio and put it over here, that would put us because we actually moved up a little bit. So it would be something like this. So that would take us down, you know, another 170 points. So roughly, if you look at this here and we look at these ratios, and let me just put it right on this chart. Well, let's get it like that so we can get this thing here so I can get the numbers here correct for you. And there's a method to my madness, so I'll show you here in a minute. It looks about like that. So that would show us next week, we could literally, if we repeat last August, it could take us down to about 1775 roughly in that area there. Okay. And then that would give us a drop uh, right down to this area right there, which would be about 16.85% roughly, right around. If you'll notice, what's really interesting here is if we repeat last August, it puts us right around that fib level, you know. And again, these are just zones, guys. It's not exact prices, but it's designed to get you down in that area just to show you what is the most and I'm saying this is a probable move. Okay. And you can see here that puts us right around a 16, call it about a 17% move down. Again, a correction, not a bear market. A bear market would take us down below 1700. So into the 1600s. So this is what I would expect. Now, if we get this, we're going to get a scare the moment in volatility. We're going to get a big spike. So if we do get this little bit of a bounce here, I would highly encourage some of you to look at your portfolio. And then our trigger and our group will be, as soon as we start that roll again, we're going to load up, because if we get down there, then we're going to be happy campers. If the market catches itself on this upsloping trend line, we're going to be watching for that catch. If it does and starts to stabilize, then we'll back off some of our shorts, right? And then the minute it comes back and breaks that trend line again, then we're going to add back into our shorts. So again, as I tell all of my folks, this is the side of the chart we trade, you know, and we do not know which way it's going to go. But the better we can analyze this for past behavior, a combination of price and volume, then the more we're going to feel a little bit more confident that we're going to have a general idea of the most probable move here. And you're never going to be certain. You're never going to be certain. And then what that would do is, if we move down into this area here, we're going to have the MACD come down like this. And then if we start to move back up like that, that would give us what I like to call a bud for our members. And these are trades that we especially love, buds and beds, because then that means, boom, we're going to have another ride up similar to that ride up there. I'm not even concerned about taking out that high in 2016. I'm not. I'm just, right now, my mind has shifted on the bearish side and trying to look at where we can expect stabilization. We will never ever be able to pick the lows, and trying to guess is a fool's game. But we can, based on past behavior, we can guesstimate where we think we can expect to see stabilization, and where the odds favor that kind of move, and the odds favor consolidation to come in. Because remember, as I said, we're still in an expansionary mode. And let's top all of this off with the earnings season kicks off on January the 11th, which is Alcoa. That, even though they're not in the U.S. Dow Industrials, they're now considered part of them. I mean, they've always been considered the start of the earnings season. So net, I think we're going to stay in correction territory. I don't see at this time entering into a bear market. But to show you what a bear market pullback would be in the Dow, I mean in the S&P 500, a bear market would take us down, right down to 20%, right in that area right there. So call it right around 1700. Okay, that's 1708, and that's 19.96. So call it 1700. If we penetrate 1700 and we see 1600 and something on the print, we're now in official bear market territory. At this point in time, I don't believe we're going to see it, okay? I believe what we're going to see is probably stabilization around this 23% fib node. And you know, when you back out, in the scheme of things, it is not a very big pullback. We will break this secular channel to the downside. That would put us down at this level right here on the E-minis. But I still think that we're still going to be in an upward momentum move, with even going back down to 1700. And if I were to add another channel on this, let me get the trend line again and put that on here and do the lows like that. There you go. So now this right here would be the I think the secular bull will be in trouble, and then we'll have a longer period of a downward trajectory and stabilization and downward if we take out this bar right here, because then that gives us that secular bull break. Okay, but notice that it puts us right at that 1787, which means if we come down here like that, then we got to be really careful, because now we're approaching bear market territory. I think this will be our line in the sand number. This will be my line in the sand number. Call it 1785 area roughly. That's my line in the sand. I'm going to plan the portfolio, and you should trade as if that's kind of where we're going to go, and adjust your trades accordingly. Okay. Now, if we come back in, and let me erase all of this, and let's go look at a couple of other things here that I think are important. One thing that we do here is I do use a lot of Fibonacci, and I plan a lot of other things as well. But one thing we don't do too much, but I do use it every now and then, is trying to guess, and it is a guess. Using Fibonacci, we can do, this is Fibonacci price, retracement, extensions, and things like that. If we use the time series, I can click on my time series bar and go from a low to a low or a low to a high. If we check a low to a high, just like that, and I program it in, you can see here that on that low to high, and we'll just blow it up here, you can see projected bottoms and highs, and the 1.61 is a very strong one, and you can see here on that 1.61 we made that low right there. And then on a 2, and it doesn't say, by the way, when you hit these levels, it doesn't say that's going to be a low or a high. It's just going to say that's in an area where the price is going to change direction. So you can see here with that 2, we were up in this area here, and then we changed direction again. So that would suggest that we may be a little bit of a spell to this time frame here, until we do one of these kind of things where we start to change direction like that. So we can look at it from that perspective. All right, it doesn't. This time series using Fibonacci does not tell you how low it's going to go. It just tells you a time frame to expect. We also use GAN. My system, I like to use GAN as well, and I can plot those out there. You can notice here that if I put this on there, that takes us out to the summer of 2016. So we could actually have a really tough start to 2016, and we need to plan for it. Okay, so I broke down the E-minis very closely here. Now I put in all of my other indicators, and you can see where we are with all these other indicators in here. I just wanted to break them out and show you what we got here. Okay, and then I'm going to take that out here because we've broken through those here. We're not going to see those again. So that's kind of where we're sitting right now on the E-minis. If we look at the Russell, which is the one that I told you guys to watch very closely because it is a key. You can look at the Russell. I've already labeled these right here. Let me just adjust that price so I get it the same as the others so that I'm looking at everything the right way here. So you can see here, I've got the opening price, the 2015 and 2016 high and lows. This is the rut. All right, notice the 2016 low price here for the Russell. And it is also challenging the 2014 low price for the Russell as well. I'll mark that on the chart here because that's really, this price right here is the lows for 2015 or 2014, sorry. The 2015 lows for the Russell were in this area right here. But you can see here the rut is down, and using my line here just to define off the highs, you can see here we're right at about 19.56%. As I said, I think I said 19.2, but that's kind of where we are off these highs made in 2015. So we're near bear market territory. We're on this Elliott wave 3-leg countdown, which would suggest that you know, my system is calculating that we can come down here and find lows in the rut sub 1,000. That is a key level for the Russell. Sub 1,000, finding lows in that area there, which would put us in a bear market on the Russell. So if we do continue down, we will enter bearish territory on small and mid cap, much like we're in bearish territory on the manufacturing sector in the US and globally for that matter. So we're going to watch this very, very closely. And we broke this key level right here in the Russell as well. And now we're at this key level right here. If we break it, then again, we're going to come down and test 1,000 on the rut. Nasdaq, which has given it up on a percentage basis over the past couple of weeks, the most, they've finally capitulated and pulled down. Okay, they've just been, you know, they've given it up. And you can see here on the Nasdaq, I've got the all-time highs bathed back in the dot-com bubble, and you can see where we're sitting right now with each of these levels. We're down now at the 2016 lows for the week, right in this area here. And year-to-date Nasdaq, we're only down 10%, but we're just really just north of this channel that we've been in for quite some time, this secular channel for Nasdaq, as you can see here, which really kicked off back in March of 2009. So if for Nasdaq to catch up to the rest of the markets and get back into the center of the channel, it's going to put us right in that area there, which would be the 2015 low price of Nasdaq, which I would expect that to happen. I mean, that's so everything that I'm seeing on all charts do expect more downside. So any up move here, I will promise you, well, there's no promises in the market other than no one knows what's going to happen. But the odd, let's say this, let's say it the correct way. The odds favor any rally is going to be sold off. We saw that in the E-minis dramatically. In all indexes, if we look at the E-minis, when we open, and I actually traded it to the upside, and we did well. We took trades into the nighttime because the markets actually opened up and just moved up based on China. And then it gave it all up. So if I just looking at this 15-minute bar chart right here, you can see right here going into the evening, and then China opening this bar right here, 8:30 p.m. New York City time is when the Chinese markets open, and they opened in the green. And down in this area here, I was going long because I said if they do open in the green, and I had shorts or stops right there. So it was a fairly lower risk trade. Boom, away we went. And then I got stopped out right in that area there, but I made some good money. And then the minute we got those highs at 8:30, we never saw them again. We continued to sell off the rest of the time from 8:30 that night all the way down. Spending time at the bottom of the channel, having a little bit of a top, and then coming back down towards the bottom. And then we finished close to the 2016 lows. This is a 15-minute chart of the E-minis, and this is the channel that we're in right now. That told me that I don't care what the markets are gonna, what the economic data is, the markets want to sell off. We're getting the valuation adjustments to all the major indices. So this is just one of the things. I spent a little bit more time than normal on this, guys, but it's very important. Any kind of bounce here, just like that, is probably going to be met with potential sellers. Again, that's what gives us our 3-4-5 pattern. You know, you got a 3-leg here, then you're going to have a 4-leg somewhere in this area here. and then boom, you're going to get that sell-off and get probably a little bit of a lower low or a test of the prior low, and then you get into this ABC pattern, and then we say, okay, which way do we go from here? That has repeated itself time and time again, both on that secular bull market from 2010 to 2015, and now as we go down like this. It's a pattern that's there, and you guys have to learn how to take advantage of it, or just join our group and follow along with what we're doing. One of the things that's cool, if you join our group, we've got for only $15 a month, after you're a member of our group, you get we're going to be starting, that you can follow along with the trades that I take. Some of them will be fast and furious. Others will be a little bit slower in time. There's going to be some trades that are more secular, and not secular, but more longer term trend, and others that'll be, in and out in a couple of days. But I see some really good opportunities setting up in 2016. If we look at volatility, now one of the things on my volatility chart, you'll see I've got shaded zones here. This is the VIX. These shaded zones represent, obviously the more you go to red, the more you're in a danger zone. And you can see I've modified my chart here so that I've got the markings on here. The 2015 volatility high was last August, when we just blew up and peaked at 53.29 in the VIX. 2014 high was 31.20. We're now in this pink zone, or this, I don't know if it's pink or going towards a shade of red. But generally, my view is when you get north of this area here, meaning you get into this zone here, we're subject to spikes up very quickly. And we don't live in this territory very long. Very rarely do we stay here for a longer period of time. So generally, when we get into this territory here, I'm going to be looking to pick up puts, generally in UVXY, or I'm going to be looking at VXX as a proxy for this thing to just come petering down. And the reason why is we don't stay up here very long. But when we get up here, you can't pass these up. And if I just let's just zoom in. Let's use a weekly chart, and you'll see what I mean. Because once we go to a weekly chart, you can see that the time spent in this red zone right here, and this, by the way, goes all the way back to 1990. So about 25 years of data here for the VIX. Look at how often we stay in this pink zone. Now, this is a weekly chart. So generally, those times that we get up in there, we're out very quickly. And then when we are in there, we're in there for about anywhere from 1 to 2 months max. The only time that was the exception was 2008, and we actually went north of that red zone, and we were there for over a month and a half. I mean, it was such an unusual time. We didn't know if the banks would survive at that point. So, but it shows you, and then in 2015, in that August blow-off, you did see where we had 2015 high. We went up into that rarefied territory here. There's only 2 times we've gone up in that area above this red zone. 2015 in that August blow-off, and then the 2008 bubble that just totally gave it all up, okay? Even in the dot-com bubble back in 2000, you can see we didn't penetrate this red zone here. So as technology becomes more pervasive, the tendency is to have higher spikes up. That's why we don't see a lot of them down here, because it creates the black boxes where you have these automated systems that just start dumping and dumping and dumping. And then we put triggers in the market that prevent it, but that's what causes these spikes. So when we get north of this area here, this green area, or this, let me just highlight it for you. Once we get north of around 20, 21, we're subject to spikes. Once we get into this zone right here, we're subject, if you'll notice in this area here, they're all spikes. That's all they are. And then when you get in here, we spike through it, and then there's nothing but spikes outside of the 2008 debacle. These are all spikes. So we're in it for 1 week, maybe 2, and sometimes even 3 weeks or 4 weeks right here. But we do not stay up there very long. That's why when the markets start going down like this, as options traders, we love living in this area right here, and we especially love living in this area here. But what that means is going from down here to up here, you've got to at least have, 50 to 60% cash available to play, right? So down here, you're not using a lot of your cash in your portfolio. Very conservative, where you can take profits early. Once you get up into this area here and we get that huge premium built into options, we want to take advantage of it. If you're pretty much fully loaded down here and then the price spikes, and believe me, I'm not worried about price spikes down in the green. Once we get into this yellow cautionary zone, we'll get the spikes right in that area there. So generally, the higher you go, you've got to be a little bit more careful. We are now in this red zone right here. So we've got to be careful of just a huge spike. And we use this, by the way. We've got a trade that we play with called XIV, and it's ratioed to go higher in a normal contango environment. We're going to be doing some more on volatility in 2016 for our members. For our non-members, again, if you're watching this video, I highly encourage you to come in, because there's some really cool plays, I believe, that are going to be coming up this year. We're going to have fun with. Okay, so that's volatility. Now let's go take a look at one other commodity here. There's so much to talk about, but I just want to share one other thing with you because it's on the top of everyone's mind. Actually, two things. One, oil. In the oil markets right here, if you'll look at it, and this is a weekly chart. We've been short oil a pretty good bit. Now, I've been playing short strangles, and 2015 was a great year for oil. We're coming down to my next target level. As you can see right here, the 32.10 is the low for 2016. My target, we're right on my target of 31.12. And my system, I could have used a combination of Fibonacci and Gann to plot this location, but my system does it automatically. It combines the two and puts a colored bar down there for an extension or a retracement, but this is an extension off the lows, and it timed it between the 23rd of December and the 11th of February. So and as you can see, all it's really showing is that the price between that time frame and that time frame could hit somewhere right around here. So call it $31 a barrel, roughly. Okay. Now it can blow through it, and then it'll be resistance to go back up, but that's what it was calling for. And we had this bar here when prices were up here. So we've been short oil. And it's just been fun, guys. And now once we hit this area here, I'm going to look for some stabilization. My system's showing it can go as low as about $27 a barrel. I would not be surprised to see it. If we get the equity market pull back to that 1787, 1790 area, we'll see oil in this area here. And if oil gets in this area here, I'm going to be happy, because I'm going to be looking at putting some trades on. Again, with our members through our Secret Trader trading service, you guys have access to it for only $15 a month. So it's a giveaway, really. But it's going to be a lot of fun. And I only charge that because it's what it costs me to just keep it going. So I pretty much give it away as a membership. But we're going to have this kind of play here. So let's have some fun with it for 2015 or 2016 with oil. So far, we've been right on with it. And then the other one I'll share, and then I'm going to end this, a little bit longer session, is gold. You guys know what I'm doing in gold. And I've been talking about it for a while, just waiting our turn. And you can see gold now. And remember, there is no inflation. One of the reasons for this fast accelerated move is there are a lot of buy stops in gold, because everybody's been short gold. We're going to be in the process of forming a consolidated pattern in gold, finding support. My system right now is looking at around 1,000, which is a good round number. We may have already probably even finished short of that, because if you'll notice, I got a support zone here that runs anywhere from 1040 down to 1030. But we're going to see some changes in the gold market and the silver market for 2016, just like we're going to see in oil. And then I've got a whole nother session on currencies. We're going to have fun in those too. Remember, the markets are getting imbalanced. Anytime we get a big move like we're getting, the markets get imbalanced. And as traders, even if you don't have time to watch it every day, there's certain imbalances you want to take and just sit on for a couple of months, 2 or 3 months, and then let it work through, and then the odds are in your corner of making a profit. So I'm going to end this session. For our members, we have our Sunday night session tomorrow night at 8 p.m. New York City time. But just as a reminder, bear market, or are we in just a correction? Right now we're in a correction, and it's too soon to call, but the odds do not favor a continuation of this correction at this time into a bear market. All right, we'll be able to have better data on it as we move, as we move forward in time. If we come in here and find support at the 2015 lows, which are around 1830, that was that last August 24th blow off bottom. If we can find buying in this area, which I think we will, then we'll stay in a correction territory. If it blows through, then you can bet the odds just went up for a bear market. Now, we are focused on down moves right now. We've got your portfolios should be set up for this kind of move where we come down like that, we move up in that area, and then we come down like that, and then we just kind of over time find ourselves down in this area right there. Still in a correction mode, and then we have one of these kind of long rounded bottoms and we work our way back up. Okay, now if we break that area, then the whole dynamic of the market changes. Okay, we're not there yet, but you've still got to position your portfolio as if that's the direction we're going. Any up move like that, we're going to be going bullish. Okay, but we're going to also recognize that we're going to be quick to take the profits, and once it's rolling over again, we're going to load back up on bearish trades. So that is what you may hear people say, it's a two-sided trade, where we do get this chop, but it's a chop to the downside. Whereas in 2012, 13, and 14, and part of 15, it was a chop to the upside. So right now we're looking at this chop to the downside, and then we're going to see if we can hold and then self-correct and start chopping back up again. All right, everybody, have a great weekend. Members, I will see you Sunday night, 8 p.m. New York City time. If you're not a member, I highly encourage you to come in and check us out. If you have any questions, just send me a note. Have a good one, everybody. Ciao.